right, welcome to Investment Banking Insights. This is the only show dedicated to helping you learn both the technical and the non-technical aspects of the investment banking process. Hello, my name is Alex Mason and I am your host, and today we're going to be going through a merger model. So if you've ever wondered how to actually calculate the accretion or dilution in an acquisition, this is the episode for you. Now, we're not going to go through the entirety of all the nuances today. I just want to introduce the concepts to you and how to actually calculate some basic numbers. So we're going to go through the essentials. And I actually thought it would be wonderful if we looked at a live deal, right? If we looked at a real deal in the marketplace. Last week, we talked about Capital One acquiring Discover Financial. If you haven't checked out that episode already, definitely check it out. But that kind of set the stage for the deal and the assumptions and some of the basic facts. So now we're actually going to use those facts to calculate the theoretical accretion to Capital One shareholders once this deal goes through. So let's go ahead in Excel and look at what's going on in this deal. So what I've done here is just put in a single sheet in a single view the essential numbers that you would need to know in order to calculate accretion and dilution for this deal. So there's three sections. The first section is basic company information. The second section are your assumptions related to your consideration, cost of capital, and synergies. And then the third section is the actual calculation of your accretion dilution. And again, this is a simplified model. It doesn't account for everything, but I accounted for the basics here. So going into this company info section, you can see I've got some info here for the acquirer, Capital One, and the target, Discover Financial. I pulled in the share price data for each company. I pulled in the shares outstanding for each company. And all these numbers, unless there's a dollar sign, are in millions of dollars just to make it easier to see on the eyes. I went ahead and assumed a 10% offer premium. I know if you actually look at the announcement, there's a 20% premium assumed. But because it's paid in stock and because Discover Financial's relative stock price has gone up pretty high in recent months, I think that the premium is actually going to be lower just because of the collar provisions that I mentioned in the last episode. So I'm going to go ahead and assume 10%. And then based on that 10% premium, you can calculate the new deal price, which is just the old deal price with 10% added on top. Over here is the equity value. So you can see equity value is very simply calculated. It is literally shares outstanding multiplied by your share price. That is it. That is the equity. So Capital One is being valued by the market at around $75 billion. Discover is being valued by the market at close to $49 billion. And then what I'm saying is I think that Capital One's going to pay a little bit more. So I'm guessing around $53 billion. So those are those numbers. And then earnings per share, I just went ahead and pulled those numbers for the full fiscal year 2024, now that those numbers are out for both companies. And then I calculated the PE ratios just for reference. But what's really important here at the end of the section is your net income. So net income, I could have just pulled this number down from a place like Cap IQ or Yahoo Finance, someplace on the internet, or the actual filings themselves. But I decided to pull the EPS numbers. So because I have earnings per share already and I have the shares outstanding already, I can multiply earnings per share by the shares outstanding in order to get the net income. So that's how I calculated that. Now, one thing that I found interesting here, Capital One's profit 2024 was $4.4 billion. When I calculated Discover Financial's profit last year, it was also $4.4 billion. So even though these two companies are being valued differently by the marketplace right now, they both produce about the same amount of profit. So I really see this more as a merger of equals than your traditional acquisition where you have big company buying small company. So let's go ahead now and look at this second section, this assumption section. I'm going to go ahead and we're going to ignore this middle section where there's debt and cash considerations because this is an all-stock deal. So it really simplifies things for us. So I'm assuming that there's 100% of the deal is being paid with equity, and that was stated in the press release. I'm also going to assume some other things in order to calculate cost of equity. So We don't really need this for this calculation, but it's really just for reference. If you remember the cost of equity formula, risk-free rate plus beta times the risk premium. So I went ahead and put those in there. And what we really want to know, though, is like your synergies. So down here, we have our synergies. Now, remember, when two companies merge, you can't just like add up the net income of both of those companies and say, all right, there you go. Like 1 + 1 = 2. Mergers and acquisitions are all about amplifying value. So how are we going to get to 1 + 1 = 3? And the answer is synergies, right? Synergies are ways that companies can either save money because of the combination, or they can make more money collectively because of the combination. Keywords, because of the combination, more than they would be able to do separately. So in the press release, we get a breakdown of the synergies. So cost synergies are expected to be $1.5 billion. And revenue synergies, they actually refer to it as network synergies, just because we're talking about financial networks, is $1.2 billion. So if we add those two up, that's $2.7 billion in synergies, which is quite a lot. That's a big claim to make, but we are talking about companies worth tens and tens of billions of dollars. So yeah, I think maybe they could achieve that. Their target is they're trying to achieve this by 2027. So remember, with the synergies, I can't just take the number they give me. I've got to account for taxes. So I went ahead and just assumed a marginal tax rate of 35%, which is this number up here. And I multiplied by 1 minus the tax rate to give me a post-tax annual synergy number of about $1.75 billion. So that's going to come in handy in a second. Now, also recall that when this deal is getting done, the investment bankers have to get paid, right? The investment bankers are getting paid for their advice, for structuring the deal. And then the banks who are helping exchange this equity, they might get a small fee as well. So I know no debt is being raised in this case, but in terms of actually orchestrating the share swap, there might be some, banks involved that may charge a fee. So I just went ahead and put 2% for financing fees, 1.5% for advisory fees on the deal. And that will come into play in a moment. So going to this third section, accretion dilution, this is where it all comes together. This is where we actually calculate how accretive the deal is expected to become. So first off, I have the acquirer's net income. This is just pulling from the first section, right? So shares outstanding multiplied by the EPS, that gives you your net income number of 4.4 billion. The target's net income, also 4.4 billion, just so happened to be that way. We also have to calculate the interest expense that Capital One would have due to debt they raised in order to get this deal done. But we actually don't need to do that in this case because Capital One isn't issuing debt. So their interest expense is not going to change as a result of the deal. So we actually have $0 in net interest expense. This is why this is a little bit of a simpler example, because in many, many other cases, we would actually be using debt and we would calculate the interest. So if we did have an interest expense, we would subtract that from the combined net income of the acquirer and the target, because that's an extra cost that's happening as a result of the deal. Also, again, doesn't take place in this scenario, but if there was cash that Capital One was using to make this deal happen, if they use that cash, they're no longer earning interest on that cash. So there's a foregone interest expense, foregone interest income that they're not getting. So we would subtract that out if that was in play here, because there's the opportunity cost. So these numbers are both zero. Here's where synergies come in. Your synergies are being added to your net income. So we already calculated the post-tax synergies of $1.75 billion. So this is going to get added into our calculation. And then our transaction costs. I'm assuming 2% of the equity purchase price is going toward financing fees and other miscellaneous fees. And then 1.5% is going toward your advisory fees, your investment banking fees. And so that's 1.8 billion, which is a lot. But this is a very, very big deal. So maybe I was a little aggressive with that number, but just for the sake of example, we'll leave it. So that gets subtracted from the number. So if you add in your synergies, you subtract out your transaction costs, you get your pro forma net income. So this is how much we expect total profit the combined entity is going to make together is $8.7 billion. Okay? That's a number to keep in mind. We're going to need that. So now we need to look at the share count. Remember, the share count is changing here because this is an all-stock deal. And initially, Capital One has 381 million shares outstanding, fully diluted. And what they said in their press release was for every one share of Discover Financial Services, Discover shareholders will get 1.0192 shares of Capital One stock. So they're creating new Capital One stock in exchange for basically destroying all of these Discover Financial shares. So using this information, we can calculate the number of shares that the target is receiving, the Discover shareholders are going to receive based on this ratio. So this is very simply the exchange ratio multiplied by the number of shares outstanding for Discover. So Discover has 250 million shares, and so that multiplied by 1.0192 is 255 million. So they're going to get 255 million shares of Capital One stock. So what's the total at the end of the day? It's the amount of shares that Capital One started out with, plus the new shares that they issued. That's your pro forma shares. So 381 plus 255 is 636 million shares. So that's the final share count. And then we can calculate earnings per share from this, your pro forma earnings per share of the combined corporation. And this is very simply your pro forma net income divided by your pro forma shares outstanding. Earnings divided by shares is earnings per share. That gets you $13.71 per share. Now, we can compare this. In order to understand accretion dilution, we compare the earnings per share of the combined entity to the earnings per share of the acquirer. So the acquirer, Capital One, they just reported their fiscal results. It was $11.59 per share. So we're saying when the companies combined, because of these synergies and all these other things added in and subtracted, you're going to get $13.71. Well, on a percentage basis, 18% increase in earnings per share, 18.3% to be exact. So this is an accretive deal if all these assumptions are correct. And that's pretty good, right? If they are accretive from day one, that looks like a good deal. So that is essentially how you calculate accretion, and you can calculate dilution. Now let's change these numbers real quick. Let's play around with this. So I'm going to go over to the synergies section, and I'm just going to say revenue synergies don't exist. So that 1.2 billion, let's just pretend like that's baloney. They're not actually going to do that. Change it to 0. Now your accretion is only 7.7%. So, it's accretive, but not by that much. And then cost synergies, let's say, you know what? I don't really believe the synergies are that high. I think they're actually pretty low. I think they're actually going to be 500 million instead of 1.5 billion. So if I put 500 million in here as your pre-tax cost synergies, boom, guess what? Now you have a dilutive situation. So the combination of the companies actually takes away from the overall profitability of the firms, which is a sign of a bad deal, or a deal that is simply going to take more time to get more, for it to make sense, for the accretion to happen. Because if synergies can happen over time, then that might make a deal make sense. And actually, in this case, the press release says that 2027 is the target year they're going to realize these synergies. Now, there's a couple other things in here. I just want to point out the synergies to break even. This is how much incremental synergies are needed for the deal to get to like a baseline 0. And that's by just taking this formula. What I'm doing here is I'm looking at the incremental earnings per share between the acquirer and the combined entity, and I'm multiplying it by the number of shares outstanding. So that's basically like incremental earnings, right? So incremental earnings then divided by 1 minus your tax rate. So that's your pre-tax incremental profit that the deal has to generate. And in this case, it's $123 million. So if I can get to $123 million in synergies pre-tax, the deal is gonna make sense. So I'm gonna go ahead and undo these numbers. So yeah, so if I have synergies, it makes or breaks the accretion dilution calculation here. And then also just to point out, Capital One shareholders, after the deal has happened, based on the ratio of shares and how much equity was purchased, they have 60% of the new company. And that's found out by taking the initial shares that Capital One has and dividing it by the total pro forma shares. Will give you that percentage ownership. So a couple of things there. I mean, just to show you how accretion and dilution works with a simple model, a simple all stock transaction. And yeah, personal thoughts on this. I think the synergies is aggressive. I don't know if they're going to be able to do that in like 2 years. I mean, we're talking $2.7 billion in savings. I mean, that's a lot to realize. And half of that almost is like revenue synergies, which, you know, are a little bit harder to prove. But I do think there is a real network effect here if this deal goes through. So we'll see. But I think this deal will be like mildly accretive with some potential upside if management does, you know, what they say they're going to do. Yeah. So I hope that was useful. And yeah, next time we'll go through a different scenario. Maybe we'll go through a debt deal or a cash deal or a mixture. But I want to show you how you can calculate this using some basic information for a real deal. That's what I got for you today here on Investment Banking Insights. I really appreciate you subscribing. I appreciate you listening. I appreciate the messages. Thank you, thank you, thank you. If you are watching this for the first time and not already subscribed to the channel, go ahead and subscribe or like it. And I really, really appreciate that. All right, I'll see you on the next one.